Hi, my name is Pranav Satheesan and I am from my business school. Today I'd like to tell you as to why I should buy Chevron stock. I shall first provide a brief overview of the oil industry, followed by the reason for which I recommend Chevron stock, and finally I shall conclude by reiterating the key takeaways of this presentation. Oil production in the world has been growing dramatically from 77 million barrels per day in 2000 to more than 93 million barrels per day in 2014. This has led to oil price decreasing by more than half. The top three oil producers in the world are Saudi Arabia, the US, and Russia, and the top six producers produce nearly 70% of the world's total oil production. The key factors which determine oil price per barrel is oil production, consumption, and geopolitics. We can see some of these factors at play over here. In the traditional oil market, the US has been a key determinant of the oil price. Oil from Latin America and Middle East reached US shores. Western Europe also consumed Middle Eastern oil. Western Europe was also the primary market for Russian oil, and Middle Eastern producers focused on Asia too. These silos represent the traditional flow of oil from producers to consumers. With the changes in oil technology and the supply glut that we have in the market, this map has slightly changed. We now have the energy independent North American zone, which produces all the oil that it needs. A traditional supplier, Russia, is now under sanctions, and the Middle Eastern producers are now primarily focusing on Asia. Latin American oil is reaching China, and Russia is also focusing for space in China. Asia has now become a key determinant for oil price. Iran has now got a nuclear deal, and Iranian capacity of 3 million barrels per day is expected to hit the market in 2016. Therefore, we now have a oil glut, and oil price has been heading south. The three types of oil companies are upstream, midstream, and downstream firms. Upstream firms are involved in exploration and extraction, midstream firms in pipelines and transport, and downstream firms in refining and products. If a company does any two or more of these activities, we have what is called an integrated oil firm. The impact of low oil prices depends on the business. Upstreamers are extremely hit. Low oil price means lower revenues for the crude oil that they have extracted. Midstream firms have little or no effect as they are involved in the transport of oil business. Downstream firms have an advantage as low oil price means low price for their raw material and therefore their profits increase. For an integrated oil firm, it will depend on the mix of up and downstream operations that they have. The strategy to follow in a low oil price environment is to go long on a pure play downstream firm, but then there is a risk that oil price might increase. Therefore, an ideal strategy will be to go long on an integrated oil firm with strong downstream operations. The upstream operations will act as a hedge if oil price does increase to a certain extent. This has led me to recommend Chevron. Chevron is an American multinational energy corporation. They are involved in almost every aspect of the oil and gas business. They have a strong downstream operations with revenues at 177 billion USD and a smaller upstream operations with revenues at 70 billion USD. The return on asset for upstream is low because of the high asset base, and it is much higher for its downstream operations because of its lower asset base there. The capital structure of Chevron is highly attractive. They have very low debt compared to equity. The debt to equity stands at just 16.7%. And even if you factor in long-term obligations, debt to equity just goes to 21.3%, which is well below industry average considering the capital-intensive nature of the oil and gas industry. The relative well chart of Chevron, we can see that the CFROI has been heading down in the past 3 years. This has been mainly due to lower production and lower oil price. This has also led to the stock price of Chevron going down. The drivers of CFROI, the sales growth has been negative in the past 3 years, mainly due to lower production and prices. The margins have been less volatile, and the asset turns has been decreasing mainly because of oil price decline. The valuations of Chevron, which are valuation metric that we take price to book, price to sales, EV over EBITDA, all valuation metrics are below industry average. Chevron has very strong fundamentals, so we can expect that in the long term, these valuation metrics will revert back to industry average or higher. Chevron has very high dividend yield compared to industry average. Chevron's current share price is just 93 USD, and this compares to a HOLT 100 price of 154 USD. This is an upside of 66% when valuations revert back to mean. Therefore, I strongly recommend that you do buy Chevron stock. The main factors is strong downstream operations, and we can expect a low oil price environment. Impressive capital structure with low debt to equity, so earnings volatility will not increase risk that much. High cash position of nearly 13 billion USD. This can be potentially returned back to shareholders. Attractive valuations. The valuation of Chevron is more of a value proposition than growth. And finally, a very good dividend yield and sufficient cash on hand to sustain the same. I thank Credit Suisse for giving me the clarity and confidence to make this presentation.